August 15th, 2024. Today was another small pullback bull trend day. I think, today was a less profitable overall or more difficult small pullback bull trend day than the one earlier in the week. In general, I thought that, when you get this sort of move and then you start to go sideways, I was hoping we were going to go sideways for maybe another 5 to 7 bars and then start the reversal up. I think the fact that we didn't go sideways for very long in here, we went down and then only sideways for 4 or 5 bars and then tried to reverse back up. I thought that might have limited the upside potential for the bulls. What you generally want to get is the market, in your perfect ideal world, small pullback bull trend is the market goes up strongly for maybe the first 20 to 25 bars of the day and then goes sideways until around bar 40 and then reverses back up. Obviously, we did not have that today. The day started with a large gap up. Let me just clear this. The day started with a large gap up. On the daily chart, you can see we're pretty overbought. I mean, coming into the day, we had this massive gap up, and you have to expect that we're going to be relatively overbought. I thought it was possible we were trying to test the magnet that I mentioned yesterday, which is the open of this bar, the 8-1 open, because it's a sell climax, and the high of the sell climax, this whole thing is the sell climax, and the high of a sell climax is going to be a magnet. Additionally, if we tested this price and reversed down, the leg 2 would lead to almost exactly 5,000, and 5,000 is obviously a really big magnet. So I thought it was possible that we start to get a vacuum test up into that 50, what's the open, 55.77 area, but obviously we did not end up getting there. However, overall on the day, I was expecting after the big gap up us to go sideways down for a little bit. In general, when you get a big gap up, the odds of a trend day are increased, so from 20% to 30%, and odds are slightly better that it's going to be some sort of bull trend day. But I still, I was still not all that bullish on the day because I just thought we were really overbought on the daily chart. Bar 1, a bull bar, but a big tail on the top and a tail on the bottom. So not really as good as it could be. I think, most likely here, we're going to end up going sideways. What do the bulls want? Well, the bulls want some sort of double bottom or wedge to the moving average and then a reversal up and a small pullback bull trend, which is essentially what they got. We did get a wedge here. I thought it was better to look at it as a lower low double bottom because 9 traded below 4 and trapped out the bulls who had to stop 1 tick below 3. Any of the bulls who bought, it trapped those traders out and then reversed back up, which makes the bull trend a little bit stronger. But in general here, when you get a big gap up, the bulls want a pullback to the moving average and then a reversal up. The bears, they don't care if we rally a little bit on the open, but they want a wedge and then a reversal down to the moving average. 2, it's a low 1 short for the bears, so we have a big gap up. You can look at bar 1 as follow through for the bulls from the big gap. So the big gap can be looked at as just a strong bull bar closing basically on its high, a big bull surprise. And then you get a follow through bar on 1, so consecutive bull bars always in long. 2, bears are hoping it's a bull trap on the open and we get a big reversal down and we just basically start to sell off back into towards yesterday's range. What are the odds of that? They're not very high. I think 2 is not a strong enough bar. If the bears were going to do that, they would need a really good, really good looking sell signal bar on bar 2, a bear bar closing near its low. And instead, they got a bear doji bar. So I don't think many traders want to sell below a bear doji bar. Bar 3, another follow through bar for the bears, but a big tail on the bottom and a big tail on the top. So probably still not quite as good as it could be. Do you buy here? Do you sell? What do you do? Probably nothing. I think it's just a trading range open. Bar 2 traded above bar 1 and bar 3 traded below bar 1. So it's possible we have some sort of expanding triangle open on a lower time frame. But the bears hoping that it's a a bull trap on the gap up in bar 1. 3 did not close below 1. So that makes this a little bit less bearish. However, it's not really all that good for the bulls because it's still a big bear bar. So do I think we're going that much higher? No. Do I think we're going that much lower? No, not really. I'm expecting a trading range open and I'd rather wait for more information. Bar 4, an inside bar, so it's a high 1. If you think of the gap up as a big bull bar, and then we got a pullback below 2 on bar 3, and now we have a reversal up on bar 4. So if the gap up is a bull trend, it's clear that this would be the high 1 in the bull trend. So bar 4, high 1 in the bull trend for the bulls. They're hoping that this is going to lead to immediate trend resumption in a big bull trend day. However, high 1s usually lead to a deeper pullback and then trend resumption. So you can see if you bought above 4, that's kind of the problem. I think one of the problems with buying above 4 is if you're buying, you know that high 1s usually lead to pullbacks and then trend resumption. But if you're buying above 4, you're probably just buying, taking a chance it's the low of the day. And so it's logical to put a stop below 3 for that reason. But you know that it should lead to a pullback. So it's kind of difficult to do that. You can buy above 4. I don't think there's any problem with doing it, but you have to realize it's low probability that that's the high of the day, or that we've seen the low of the day. So if you're doing so, you're taking a chance. We're still in a bull trend, low one or high one in a bull trend. Stop below 3, you buy, and you take a chance that we get a big rally. 5, a doji bar. For me, if I bought it above 4 and I saw 5, I would just exit the trade. I don't think it's really worth staying long. Some traders, let's see if they got 2 to 1 of their true risk. Yeah, so some traders, one of the big reasons we reversed up here is the true risk. When you buy above 4, you buy here, and you're going to initially put a stop 1 tick below bar 3. You don't know how much of a pullback there's going to be until the pullback happens. During bar 5, you get the pullback, but it's just a doji bar. So if you're a bull, you were hoping the follow through bar for bar 4 was going to look something like bar 9 maybe, or whatever, bar 31. You wanted to see a really big bull bar closing near its high. And instead, when you get a doji bar, a lot of bulls will switch from scalping mode or from swinging mode to scalping mode. So you really only had to have your stop theoretically down here, which it was a little bit past the 50% pullback, I believe. Yeah. So you really only technically had to have your stop 1 tick below where the low of this doji bar was. You don't know that going into the trade, but once it starts to reverse up, maybe the close of bar 6, you can tell that if you had your stop 1 tick below here, that you would not have been stopped out. So why does that matter? Well, traders will call that actual risk. You can have your stop as wide as you want, but how far does the market actually go against you? And so you can see on bar 5, the market goes against traders who bought above 4 a couple of points, and it closes as a doji bar. Again, if I'm buying here, I want really, really good follow through. And when I get a doji bar, in my mind, I'm now scalping. So what do? Well, they go for 2 to 1 of their actual risk. Their actual risk is 1 tick below here. And once you see bar 6 closing, it's pretty obvious that that's probably the target that we're headed at. And that's why there's so much dramatic selling on bar 7, is because the bulls, they thought, or they're not as interested in this anymore. They think it's probably a trading range open once you get the doji bar on bar 5. So they scalp out of the trade, and that causes the big reversal down on bar 7. But anyways, bar 6, another bull bar, closing reasonably strong, but it doesn't close above the bar too high. That's a big problem. If you're a bull and you bought here, you really want to see the market close above the bar too high. Instead, you got 6 isn't disappointing, but the tail on top is a little larger than you want it to be, and it can't close above the magnet. So you have to ask yourself, does this look like the start of a strong bull trend? Maybe 4 is the start of a strong bull trend, but 5, a doji bar for follow through, and then 6, the tail not closing above the breakout point. Does that look like the start of a strong bull trend? No, not really. I'm not really a big fan of that. 7 got really big. 7 was smaller and closing in this area earlier in the bar, and I thought had to be closed, somewhere in this area, it would have been a much better sell, because it would have been the risk would have been a lot less big. So if you're selling below 7, maybe 50% chance we've seen the high of the day at that point, but you would probably still be a relatively similar probability if it closed somewhere up here, and your risk reward would be a lot better. So additionally, when 7 goes outside down, this is such a big bar closing in the middle of this range, it looks like more of a trading range bar. I think it's still credible to sell below 7, taking a chance that we've seen the high of the day. It might be an expanding triangle open, so there might be more buyers than sellers down here. And you had a credible buy above bar 4, so still reasonable to be long. We haven't stopped those traders out yet. So here you could probably be long or short, but I don't think either one is all that great. I think it's probably better to just wait and see what happens. It's really hard to want to sell below bar 7 since your risk is so large, 12.5 points. So I don't really want to take that trade. 8 consecutive bear bars. So I think 8 makes the market always in short. But you have to remember, with always in trading, once the market becomes clearly always in short, like bar 8, if you're in a trading range, the odds are that's exactly where the market might end up reversing. So yes, always in short, but might be more of a trading range always in short and a bear trend always in short. Is it still okay to be short? Yeah, it's probably still not illogical to say we've seen the high of the day and continue to hold short. But if you get 1 or 2 bull bars closing against you, it's probably better to just get out. 9 does something really important that I already mentioned, but first off, it's a wedge, 1, 3, 9, or you could argue 1, 4, 9. 3 is a little bit of an overshoot of the bear channel, or the channel line, sorry. And then it's a lower low double bottom with bar 3 or 4, whichever one you want to say. So the bulls, what do they see? They see a double bottom bull flag. And when you get a double bottom bull flag, you can remember we have this big bull bar, and then we went sideways, creating the double bottom double bottom, bull flag, 40% chance you're going to get a measured move up into this area. So anyone buying above 9 knows 40% chance they're going to be able to make 25 points before they lose like 10 or 11, which is reasonable math, but it's not overly great. If you're 40, getting 2-to-1 of risk reward on a 40% trade is the bare minimum you can get. And one time Brad described it as kind of like getting a D on a test. So really, you don't really want to get it. It's just the bare minimum you can do to pass. So it's passable, the trader's equation, to buy above 9, but I would personally rather wait to see if we get consecutive bull bars closing near their highs. Remember, 7 and 8 still exist, and they're pretty strong consecutive bear bars, so it should get a second leg sideways to down. So I'm not all that confident in buying above 9. Yes, lower low double bottom, but big outside bar. Look at this. We got a big outside down bar and went outside down of a small bull bar. Now we're getting big outside up of a small bear bar. So while it is reasonable to take the buy, wedge, or lower low double bottom bull flag, whatever you want to describe it as, I'm probably going to put that in my I'll throw it in there. I think that's what I was looking for. While it is reasonable to take the buy, it might not be as good as it could be. The one thing you do have going for you is that the bulls who bought above 4 and put a stop below 3 got stopped out on bar 9 and the market reversed back up. So all those bulls are probably not too happy with that, and the market is now going in their direction without them. So they're going to be pretty aggressive and look to buy again above any bull bar, whatever, 9, 10 closing near its high. 10 consecutive bull bars closing near their highs. So it's reasonable to buy the close of 10. We're probably back to always in long. And I think if you're a bear for any reason, I don't know. I don't think you have to get out above 9 if you were short for any reason, but you definitely have to get out above 10 consecutive bull bars closing near their highs. The reason it would be is that, we're back to always in long, and you know that 9 and 10 is now going to get a second leg sideways to up. You don't know if just bar 9 is going to get a second leg sideways to up. But once you get 9 and 10, we're probably going to go at least a little bit higher. So it probably just makes more sense to get out of the trade. But consecutive bull bars closing near their highs, we're always in long. And now your probability is a bit better, and you're basically getting an entry around the same price as buying above 9. If you wanted to, you could even put a limit order to buy 1 tick above 9. You'll probably get filled because this is the 9 high, and 1 tick above that is right here. So you can see, it would be 0.50. Just for the sake of argument, I'll show it. So, right, if you get this close, what are the odds we're going to go here on the next bar? They're probably pretty high if the next bar closed 2 or 3 ticks above it. So you could put a limit order on bar 11, trying to get filled at the bar 9 high, expecting that you'll be able to get filled and have better probability. Notice also the traders, let's say a trader sold above bar 9. They sold above bar 8 as bar 9 was rallying. Well, they obviously did not like how bar 9 closed, because as bar 10 got back to the high of bar 8, they bought back their shorts. And see, immediately, the moment it got back, they immediately bought back their shorts. What bears who sold 7, 8 were hoping for, they're hoping that this is the high of the day. And if it is the high of the day, the bears should have been more aggressive about selling in this area, and we should have gotten a bear close somewhere in this area, or at least a reasonably good bear close closing below the bar 8 high. You wanted more uncertainty for at least for the bulls in this area. So if you were a bear, you wanted not bar 10, basically what you wanted out of bar 10, so that you could make an argument that this is still the overwhelming force in the market, except for the fact that 9 just needed one more bar and they got it on 10. So disappointing, really disappointing for the bears if you were short for any reason, that traders bought back shorts at the 8 high during bar 10. Then 11, another follow through bar. It's 3 straight bull closes, but we have shrinking bodies and increasing tail size. Might be more of a trade in range open. It's still credible to buy above 10. We are always in long. Bull bar closing near its high. And again, like I said, double bottom bull flag. So still reasonable to do that and be long for whatever reason on bar 11. Also, bar 11 closes basically a tick or two above the bar 10 high. So some bulls will just buy the close of 11 or buy above bar 10 during the tail on bar 12, because they now have more information. They have 3 straight bull bars now, and the bears have not gotten 3 straight bear closes today. No one has gotten 3 straight closes today until now. So with 3 straight closes, 9, 10, 11, the odds are increased for the bulls that they're going to be able to do something here. 12, a bull bar. You can see it's basically broke out above the high of bar 11. There was a little bit of a channel line going from 9, 10, and 11. And then 12, just look at the bodies, right? The bodies is the easier way to look at it. You can see, because I know it can be confusing to look at these, but just look at the bodies, 9, 10, 11. We're kind of forming a similar channel line on those bodies. And then bar 12, a climactic breakout above that high. So what do we do now? Well, there's a tail on the top of 12, which is not as good as it could be for the bulls. You can see they were initially sellers above the bar 7 high. So traders, maybe they sold, maybe they scaled in, they're going to try and get out. And you can see, obviously, they were never able to, and they end up getting forced out. So a good looking bar or not a great looking bar on 12, but it was still a breakout attempt. And we now have 4 straight bull bars. So although the bulls aren't, we're not rocketing up, but the bulls are winning a little bit with time here because we have 4 straight bull closes. And that's really important. And again, we have 2 of them that are reasonably strong. So if you're long, you want it, or if you're trading in either direction, you want your direction to win with either price or time. Price being you get really strong consecutive bull bars. So if, we got 3 straight bars that looked like bar 19 in a row, that would be winning with price. You're covering a long distance in a short period of time. Or you can cover a long distance over a long period of time. But you can get, if the bulls get 6 straight bars that look like bar 11, well, it's still pretty bullish. It's still 6 straight bull bars. So, you have to pay attention to what the market's doing. However, obviously 3 of these is more bullish than 6 of these. 6 of these is a leg in a trading range, but traders will be willing to buy below and scale in lower. This all in itself didn't look like a huge bull trend starting to form, but obviously the small pullback bull trend days usually do not look that way. 13, another bull bar. So it's an inside bar, high 1 for the bulls. If you buy above 13, yeah, you can. It's 5 straight bull bars. The problem is you might be buying the top of a trading range, and we could be forming some sort of wedge, 1, 2, maybe 3 somewhere up here. You can see it did end up being an expanding triangle open. It's just we broke out to the upside of the triangle. 14, disappointing that we have such a big tail on the top, but still credible to be long. And it closes above the high of bar 7. So it's the first bull bar we have closing above the breakout point. However, we need another bar breaking above the high of bar 13 now. And then we got 15, another inside bar, another high 1. So high 1, 13, high 1, 15. Reasonable to take these buys, and you probably have to have a relatively wide stop, trade small, and just assume that you've seen the low of the day at this point. 16, a big tail on the top. So similar follow through for the high 1 of 13 that you got on 16. Really not as good as it could be. Probably still buyers below 16 within a couple of points because obviously 9 through 16 really, really strong. So the bears, yeah, maybe their argument is it's a wedge, 1, 2, 3, but no one's selling below 16. That's not going to go very well. It's, you're selling against basically 7 straight bull bars. So no one wants to sell below 16. Might be, like I said, a wedge and another wedge, 12, 14, 16. But whenever you see wedges forming in one direction that are really not all that good, you have to keep in mind that on small pullback bull trend days, the market forms a bunch of wedges, but they end up just being meaningless and just lead to continuation patterns or just become continuation patterns. So it's probably not as good as it could be to be looking to short somewhere in here. But again, buyers below 16 for any reason. If you buy below 16, where's your stop? I don't know. I would probably have a pretty wide stop. I don't know how much further it's going to go down. Is it a scalp or a swing trade? I think you can probably do either. You can buy below, taking a chance. We started a small pullback bull trend day. Obviously, people who trade on limit orders are usually scalpers instead of swing traders. 17, initially buyers below during 16, and there's a big tail on the bottom showing there were buyers. 18, a micro double bottom with 17. It's a lower low double bottom, but and a high 1 for the bulls. But there's one particular thing that happened here that if you saw it, it probably changed your entire perspective on the day. When we started to rally above this high, the question you should have been asking yourself when we rallied above this high is the bears who scale in, are they going to have a chance to get out at the 7 high? Yeah, you can make an argument that if a bear sold during bar 14 and scalped out really quickly, they could have made money on 15. But most of them are probably not going to do that. They're looking to sell here and scale in 2, 5, whatever points higher. You can see, we went 5 points higher on bar 16. So once we started to pull back here, the question becomes, are we going to overlap with the bar 7 high? Because if we don't, that would create a gap. And you can see we have an open gap with yesterday's high down here, right? We don't overlap with yesterday's high. So any limit order bears who sold there are now trapped. Side note, this is kind of a triangle too. It's obviously not as clear of a triangle as the one we had the other day, but it is still a triangle. But if it doesn't overlap, then we're going to end up, it's going to be two open gaps early in the day. And whenever you have two open gaps early in the day, sorry, I forgot to put it in that category as well. I mean, we can just click through these. Obviously, sometimes the gaps close later in the day, it becomes a trend day. But if it's you have to learn context, but whenever you have a couple open gaps early in the day, the odds are you're going to get some sort of trend. Again, occasionally you will get a trading range and the gaps will close, but odds favor some sort of trend if that's what's happening. This is a prime example. Open gap, open gap. And, the traders who sold the high, it needs to drop one tick below the high of bar 7 in order for those traders to make money. Because if you've ever had the market, if you've been trading long enough, you'll have this happen where the market hits your limit order to exit a trade and it doesn't quite fill. So it'll hit the limit order, but it doesn't fill. It's because I believe it's 80 to 90% of the time, I think it's closer to 90% of the time, the market has to go one tick past your limit order to fill it. So if the market hits your limit order and fills it, you got lucky. It was a good 10% of the time, which means that 10% of the bears got out here, but 90% are still trapped, which is still a lot of fuel to add to the fire to the upside. 19, a big bull bar closing near its high, closing above the bar 16 high. To me, 19 is a really strong buy. You have now an open gap with the 18 low and the 7 high, and we're closing above the 16 high. So I think that's really, really important. Why is it important that we close above the 16 high? Because we created the open gap and then we closed above the next breakout point. Doing both of those things is really, really important. And you can see some bears, maybe they sold above 18, expecting another leg down, or they sold above 17 as 19 was rallying, and neither one of those traders were able to get out. So we have even more trap traders on this side. 20, a doji bar. It's a bear bar, but I don't know. I'm not really willing to short. At this point in the day, what I did was I bought 19 and just put a stop below 18, and told myself I was gonna move up with the higher lows and lower highs, and I ended up making a silly mistake, and I basically broke even on the trade. I didn't do very much today, but regardless, what I was trying to get at is you can see it's possible small pullback bull trend day, and you can move your stop along with the higher lows and lower highs, along with the higher lows. And if you're in a bear trend, you can move your stop along with the lower highs. However, something to keep in mind is that is not a very effective strategy on trading range days. So we've had a lot of trend days this week, and if you've been using that strategy and making money this week, you're doing a good job. But you also have to keep in mind that on trading range days, that's not going to do very well for you. You have to try to get out faster, higher in trading range days. So if we start to have a trading range, I suspect tomorrow will be a trading range day. We've had a couple of bull trends this week, or a couple of trend days. So I think tomorrow will probably end up being a trading range day. If not, I think it's odds favor a bear trend day over a bull trend day because we're overbought in the short term on the daily chart. So 20, a doji bar, trap traders, bad follow through, but still reasonable to be long. The context is good for the bulls. 21, another bull bar, a tail on the top, still reasonable to be long and buy for any reason. Put a stop below bar 18 and just hold. 22, consecutive bull bars, a big tail on the top of 22 and on the bottom of 22. For a little while here, like bears are just hoping for some sort of wedge, but it's really not working. I think the bulls have much stronger arguments and open gaps. So to me, this is bullish until the bears do something really clear. 23, another bull bar. It's an inside bar closing relatively near its high. It's a high one for the bulls. But remember, high ones usually lead to deeper pullbacks and then trend resumption, i.e. here. We did not get the deep pullbacks here, but you can see the market still pulled back, and the market still pulled back. So probably going to get pullback relatively soon here. 24, a big bear bar closing near its low. Bears want a wedge, 7, 16, 22, but I don't really think that's a very good sell. Probably buyers below 21, 22, 23, 3 straight bull bars, and micro channel from 18 to 23. So, it's really easy when you're starting out trading to see small pullback bull trend days, and you do a good job and you get in the market. You get in the market somewhere in here. I remember I used to do this kind of stuff where I would buy here and exit here. And then, I would maybe do nothing here. Way back in the day, I'd probably sell that when I was, just starting like a year in. I can't tell you guys how many bull trend days I've scaled into the wrong way. But the reality is you just have to do it a bunch of times and then you'll eventually get better at it. Or, but then you start learning to buy on the small pullback bull trend days, but you keep getting trapped out. I used to, buy here, exit here, do things like that, and then I'd watch the market go up without me. And it'd be really frustrating. But the thing you have to think about is the premise of your trade. Here we had two open gaps for the bulls. And so we had a strong bull trend and we hadn't touched the moving average. So there's no reason to exit below these minor reversals. It's more likely that they're going to lead to bull flags. I understand that it's easy to look at the bear trend bar and get scared, but you just have to think about the math. And it's the same thing over here. Whoops. I completely understand that 24 is a scary bar and it makes you question everything that you're doing if you're long for some reason. If you bought above 23 and you see 24, if you just started trading, that's really scary. But if you're trading small, you can buy above 23, put a stop below 18 and not be worried about it. And your premise is, well, we have two open gaps and we haven't touched the moving average yet today. I think it's a small pullback bull trend day. So I'm not going to exit on reversals that are probably minor, like 24. 25, disappointing follow through. If you sold below 24, obviously disappointing follow through. Most traders are not going to do that. Probably, maybe we get a small second leg sideways to down, but obviously I think we're going higher. And then you can see 26 rally or sold off back to the bar 24 close. Any bear or algorithm who sold below 24 sees 25 is disappointed and buys back their shorts during 26. It's notable that 24 is a pretty strong close, and so we might rally a little bit longer, but we might have to test back to this area because this was a surprisingly strong bar. So I think that's what this whole thing was doing, was trying to test back to the bar 24 close. Anytime you get a really strong close, it's going to become some sort of magnet. And 24, it doesn't mean it's the end of the bull trend, but we could get one more leg up and then start to go a little more sideways. 27, a big bull bar, but a tail on the top. You can see we broke out above the bar 22 high. Good for the bulls. We might go a little bit higher. But at the same time, we did just get a pretty strong bear bar, but still always in long, no reason to sell. 28, an inside bar, bull bar closing near its high. It's a high one for the bulls. Again, remember, high ones lead to deeper pullbacks. If you're trading and you think it's a small pullback bull trend, at this point, once you get 27, 28, your stop goes below 25. You can see we formed a wedge, 1, 2, 3, and this might have been the start of the bull channel. And so it was reasonable to think we were going to test back into this area. What I did today, this was my dumb thing that I did, was I basically, I bought and I held and I had a stop below 25. I figured we might test near 25, but probably weren't going to go very far below it. And then as we got close to it, I just exited the trade for basically break even. Had I just kept my stop where I expected the market to test to, but not go past the 25 low, I probably would have been fine. And I would have, I basically just decided I was going to hold through the midday pullback and then look for a second leg up. And I was right, but sometimes you just do silly little things and you end up, not making as much money as you could have on certain days, or not making money on certain days because of that. But it's, it's not a big deal. 29, disappointing follow through. You can see we got sellers above the high one initially. And then 30, a big bear bar closing near its low. Why does 30 happen? Well, a couple of reasons. You could argue that the bears who bought, or the bulls who bought the close at 28 were disappointed with 29 and used the small rally on 30 to just sell out of their longs. Some bulls are fine with sitting through a pullback. So a pullback, regardless of how deep it is, if it doesn't go below the prior high or low, traders will still consider the bull trend on. So some traders are fine with sitting through 30. Other traders are not, and they want to get out faster. So they'll sell out around the 28 close during 30, causing 30 to close near its low. Outside up bar 31, good for the bulls. We're probably going at least a little bit higher, but I'm not sure how much is left of this. We have a pretty strong bear bar 24 and a pretty strong bear bar 30. So although we might continue to rally, I'm not sure that we're going to go all that much higher. 32, an inside bar. So it's an IOI pattern, 30, 31, 32. To me, that's a final flag. I think that even if we start to bounce here, we're probably going to end up going sideways and coming back into this area. 33, an outside bar. You can see there were buyers below 32 initially, probably going at least a little bit higher, but I'm not sure how much higher. 34, a bull bar, but a tail on the top. And then 35, consecutive bull bars. But what do you notice about 34, 35? Big tails at the top. Also, we're breaking out above this bull channel line. You could argue it's here, something like this. I was drawing it kind of more like this because it's more of a wedge. But it's pretty clear, regardless of how you're drawing it, that 34 and 35 are breaking above the bull channel. If they're breaking above the bull channel, maybe they're trying to test the magnet that was somewhere up here. I thought we might try and get up into that area. But regardless, it's breaking above the bull channel. When you break out above the bull channel, there's a 70% chance you're going to end up testing the other side of the channel within, 5 to 10 bars. I'm not sure how valid that, well, it's pretty valid in this situation, but you have to be careful applying that situation or applying that to context in trends. It's usually a better stat for trading ranges when you get climactic breakouts below channels and trading ranges that are unsustainable. So you can, it's credible on 35, 36, but that using that kind of stat for trades can get you in a lot of trouble in certain areas of the market. So just be careful with it. 36, an inside bar, a high one for the bulls, but we're way overbought and it's a bear bar. So let me get a drink of water real quick. Probably buyers not too far below 36 and probably sellers not too far above. You can see we traded below 36 and there was initially buyers below. Regardless, you know that 34, 35 is going to get a second leg up. So you know that we're probably going to go at least a little bit higher. 30, but we might pull back first, right? And the pullback could be pretty deep. 38, a bear bar closing near its low. We're probably getting to the moving average at this point, but bulls are going to buy the moving average. 39, another big bear bar, tail on the top, tail on the bottom. We're touching the moving average at this point. So the gap bar is 40, the first bar to close below the moving average. And traders will just buy the close, taking a chance. We haven't touched the moving average all day today. They'll just buy the close and the first close below the moving average, first touch of the moving average. Some for a scalp, some for a swing. The swing would be hoping we get back up into this area, which we probably will. 41, an inside bar, a high one for the bulls, but it's not a very valid high one after this big sell-off. The bears are hoping it's a low one in the start of their new bear trend. But I think for the bears, if this was going to be a bear trend, 39 and 40 had to look a little better. 39 didn't have to look a little better, but 40 needed to close on its low. If 39 was going to look like this, if the bears wanted a chance at a bear trend, I think 40 needed to close on its low. And 40 getting bought up so much makes it a lot less good. If the bears can get the first bar that closes, or the first close below the moving average to close on its low, then that's really, really strong for the bears. If 39 to close on its low and 40 to close on its low, that would have dramatically increased the chances that this ends up becoming a bull trap and we start to sell off and get some sort of endless pullback. 42, consecutive bull bars, but a tail on both sides of 41 and 42. This is a minor reversal, so we're going to try and form some sort of lower high from here. It's not really worth trading anything in here, though. 43, buyers below 42. You can see 41, 42 probably getting a second leg up. And this whole thing, if you just look at it on like a 15-minute chart, if you think about it, the only reason I say that, I mentioned the higher time frame is because if you think about this, it's a breakout on a 15-minute chart or whatever. It's not as clear as I want it to be. Some time frame, it's a breakout, a couple of breakout bars. You see, the only reason that I mention that is because you should think of this bull channel upwards as something that is going to get a second leg. So even if we go sideways for 10 to 15 bars, this is still in control of the market and it's going to get a second leg up. 44, an inside bear bar, low one short, closing near its low. But no, you're selling low in what's best case scenario, a trading range for the bears. You're selling way too low. This is all probably a trading range, this upper area. And this was a logical spot for the bottom of the trading range. So you're not selling 44. 45, the bull bar, it's a high two for bulls, high one, pullback, high two. But I'm not sure I want to buy above this bar with a big tail on the top and a tail on the bottom. I'd probably rather wait. It's reasonable to look to buy a high two in this area, but it just doesn't close very strong. And I thought we should go sideways more first. I thought that if we went sideways, maybe until bar 50, maybe 50 to 52, somewhere in here, and then got maybe, one, pullback two, and a little sideways, and then three, and then a reversal up, it had a better chance of a second leg, a better looking second leg up. Or, probably even better, honestly, if we went sideways, one, pullback two, and then got some sort of truncated wedge, but we did get a third leg down and then a rally. I thought that would look a little better. But I just didn't think we went sideways long enough in here for this rally to become significant. So 46, a doji bar, disappointing. We're in a tight trading range. You can see 47, another doji bar, disappointing. So we're again in a tight trading range. Nothing to really do here. 48, a bull bar, but a big tail on the top, closing around the 47 high. Just really not much we should do. We can do at this point. 49, a bull bar closing near its high. Consecutive bull bars, but this one not all that great. Back to always in long on 49. Yeah, we're back to always in long, but this is not as great as it could be, I think, to buy for a second leg up in this area, because I just thought we had to go more sideways first. 50 bar 50, 3 consecutive bull bars. We haven't traded below another bar since 45. So 6 bar micro channel up, probably buyers below 50 during 51, which there was, and a second leg up from this. 52, a bull bar closing near its high. Do you buy above 52? I don't know. Kind of tough. You can. We're always long as the bull bar closing near its high. So yes, you can buy above 52. But I'm just thinking optimal. What's optimal here? Is buying here optimal? Probably not. We might go a little bit higher, but I thought we really had to go more sideways first. So if you're buying, the upside is probably limited, and look what it did, right? So how profitable was your trade if you bought there? Probably didn't make all that much money, if any. 53, another bull bar, so consecutive bull bars. 52, 53, probably buyers below. 54, buyers below, outside up. And you can see we broke to the new high, 55, but not all that strong. Let's see if the bulls can get a bull bar closing near its high for some sort of consecutive bull bars and get some sort of rally to the upside. And then you get an inside bar, 56, disappointment. Bears, you could argue it's a wedge. We traded below 50 during 51, so that's 1. And then we traded below 53 during 54, that's 2. And then 56 is 3. So you're hoping it's some sort of wedge, maybe some sort of larger wedge, 1, 2, 3, but I don't know, not worth doing. 57, a bear bar closing near its low. I would get out of my longs here. It's tough because, it's probably a minor reversal, and the bears need 58 to be a big bear bar closing near its low to flip the market to always in short. So we still are always in long. There's probably buyers not too far below, and we're going to get a second leg up back to the 55 close. But, I don't know. This is just, what are you hoping to accomplish if you're holding long below 57? Are you trying to just get the market back up to the bar 55 close and then exit? Well, the risk reward isn't all that great for doing that, because we could move down pretty quickly. If you're doing that and 58 is a bear bar closing near its low, then you have to exit. But you don't have to exit below 57, but I just don't think there's that much left to the upside. So it's probably better just to get out and probably just, the only thing left to do on the day is look for a reversal down, but I don't really want to look for a reversal down on a bull trend day. 59, an inside bar, a high 1 for the bulls. 58, disappointment for the bears. 59, an inside bar, a high 1 for the bulls, trading back to around the 57 close, and bears buy back shorts, causing 59. Taps a big tail. 60, a bull bar, but a tail. An inside bar, 61, bull bar, 62, and then breakout above 63. But you can see disappointing follow through 64, relatively expected. And then we traded back into this range. 65, buyers below, and then you can see 2 legs down, 1 pullback 2. And again, this touching the moving average and this pulling back this much. Yes, good looking reversals up. We're getting, not good looking reversals, but we're getting big reversals up, but there's nothing to buy in here. And then we get another breakout of the high on 73, but it's a wedge. 1, 2, 3. And yes, I mentioned earlier that bull trend days form wedges that often end up being pretty meaningless, but we're pretty late in the day, and this doesn't look like a big bull trend to me anymore for the reasons I've been mentioning. So you could probably sell below 75, but 74 is your signal bar. So not as good as it could be. So it's logical to do, but I would not. I would just be done for the day. This looks like a trading range. Quite frankly, for me, once I see 57, I'm probably just done for the day. And if you sit around for a few more bars and we start to go sideways, 65, 66, then I would just be done for the day. So we've had a couple of bull trend days this week. I am expecting a trading range day tomorrow. We had trading range day Monday where we had a bear trap. We've had a couple of traps this week. Traps on the open are really, really fascinating. But anyways, I'll make that in some other video. For stop orders, I think it's okay to buy above 4, but the logic is conflicting because it's a high 1, so it should lead you to a deeper pullback, but you're buying for the low of the day. So maybe you can put a stop a couple of points below 4, but I'm just not that sure. Maybe a measured move if you wanted to, but you'd have to see how it goes. You could probably sell below 7. It's a big enough surprise for a second leg down. But it's not quite what you wanted to see here, but it's still reasonable. I personally would wait for 10. I personally would not buy above 9. I would prefer to wait for 10. It's probably not illogical to buy above 9 because of the wedge and double bottom bull flags, but I would just rather wait for 10, and then you can buy the close of 10. You can buy the close 13, 15, 19 makes sense after the second open gap. These are by the close, but you're getting pretty high in the range. So if you're doing so, stop below here. Maybe you can buy. I would not buy this or any of this. it doesn't really make that much sense to sell, but you could probably sell below 38. That makes the most sense betting on a test of the moving average, but it's more of a scalp. 5-6 points to get out, second leg down, reversal up, always in bears, probably exit above 45. You can buy above 50, but just, you can buy these closes, but it's just like difficult. Like this is, you know what I mean? You look at this and you kind of were, well, that didn't do what I want it to do. And if you take this trade, these kind of trades, a lot of the time you're going to find you're either going to outright lose or you're going to sit here at the end of the day and say, well, it really didn't do what I wanted it to do. So not overly optimal trading towards the end of the day. The daily chart, I think, getting steeper, right? So I do not think we're going to race up to this area. I still don't. I think we're probably going to start to go sideways pretty soon here. I think the sell climax high is a target, probably going to start to go sideways pretty soon. The weekly chart, the bulls are doing an excellent job of making traders think that this was just a bear trap and we're still in a bull trend. But how many of these can we get, right, before traders just conclude we're in a trading range? So do not be surprised if the bears try to put a pretty decent tail on that bar tomorrow. I would be surprised if the week closed near its high. So tomorrow, I'd be interested to see if the bears try to put a really big tail on this week's chart. I believe, well, I guess, on a bull trend day, if you want to buy on limit orders, the ways to do it are buying below bars like this. This is a good buy below. I probably wouldn't buy below 6. I'd rather wait. But you could buy below that. You could probably buy below this, but if you buy below this and exit below 24, you should not be trading on limit orders. Probably buy below 50. That makes sense. This makes sense. And those are the easy ones on the day. So, all right, that's the day.